I didn't think I could see you.
How are you?
Well, I think we're going to go ahead and get started. I know we have some folks that are joining us online, virtually, and we have a group of colleagues here in the room with us this morning. And again, we're just happy that we can be together and learn about, get the market update from Dave Smith at Marquette Associates. So I'm going to go ahead and get us started then. So my name is Kay England. I have the privilege of serving as the president and CEO of the Community Foundation of Northeast Iowa. We just, again, look forward to this opportunity to gather with some of our professional advisors, board members, investment committee members, to have the opportunity to learn more about our portfolio and a little market update today. So I want to go ahead and introduce some folks that are with us today that are serving in a leadership role at our foundation. So I would give special thanks first to our investment committee members. Some are in person, some are virtual, so I'm not going to try and point out where they're at. But Todd Henningsen, he actually is the chair of the investment committee and also is a board representative. Nick Blasberg, Stacy Brass, Mike Hume, Mark Miller, Matt Monahan, Pat Monett, and Gary Winterhoff. And today we are also welcoming three new committee members that'll be joining us on our investment committee. And that would be Justin Dams, who's here with us today, Betsy Vogel, who's in the Decorah area, and Christy Brown from over in Kasuth County. So we do look forward to the work of that committee as we continue to manage our portfolio and make smart decisions to manage the assets and the partnership that we have with Marquette and Associates. Also want to give a shout out to all of our board of directors. In our room today is Scott Cernett, who's going off both the investment committee and the board of directors, and certainly want to thank him for his leadership and the work that he has done. Also, we have some staff with us today. So Liz Kurt, who's our VP of Administration and Operations, and Terry Gomer and Lori Everhart, who work in our development department. So really happy that they could be with us today again, too. So one of the major responsibilities of both our board of directors and, of course, this investment committee is to provide the oversight of our assets and to really ensure that that fiduciary responsibility is being carried out in our important work. Our assets are around 159 million, I think, as of today. So we've just been so fortunate and really experienced some great additions, both in new gifts, and of course, the markets have been really good to us the last couple of years as well. So I'm going to go ahead and turn it over to Lori Everhart, who will share a few updates and introduce Dave.
Thanks, Kay. So today, as Kay mentioned, is the first of our professional advisors events. And we will host 4 total throughout the year. And we certainly hope that these opportunities to learn together will be meaningful and helpful to you in your practice. Today's session also has continuing education credits available for those of you. Who are here in person, if you didn't get a chance, be sure to sign in the back. Let me know which credits that you are needing to make sure that we can receive those. And for those of you who are joining us remotely, I will be following up with an email with the CLE number for those continuing education credits. And if you need CFP credits, we'll be able to get your number and get those taken care of as well. So before I introduce Dave, I want to do just a real quick bit of end of meeting housekeeping. This seminar is being immediately followed by our quarterly investment committee meeting. So after we conclude at the end with any questions, we'd just like to invite you to feel free to continue any conversations in the lobbies as we move tables and get ready to transition to that next meeting. So thank you all for being understanding of that. So without further ado, we'll get Dave up here. So Dave Smith is Managing Director for Marquette Associates and serves on the firm's executive committee. And owner of the firm, Dave has been with the company since 2009 and has 25 years of investment experience. He leads the healthcare practice area at Marquette and is a member of the Endowments and Foundations Services Committee. And he serves as the lead investment consultant for several key client relationships. Prior to joining Marquette, Dave was Vice President of Investor Relations at Northern Trust Asset Management, where he was responsible for serving large institutional investors. He began his career at the Chicago Mercantile Exchange with a Eurodollar derivatives trading firm. Tell me what that means. Dave holds a BS in Business Administration from the University of Richmond, an MBA in Finance from the University of Chicago's Booth School of Business. He is a CFA charter holder and previously served on the board of directors at CFA Society Chicago. He's co-chair of the Investment Management Alumni Roundtable at the University of Chicago's Booth School of Business and is a member of the Economic Club of Chicago. So welcome, Dave.
Thanks.
Awesome.
So I'm from Chicago and it's cold here, which basically means in about 24 hours, it's going to be cold there, which is perfect if you built a backyard skating rink for your kids.
Yeah.
And so this is, we've now been doing this for a number of years. We did it virtually last year. Allows us to have some conversation around the things that we're thinking about for our clients, other clients, just like the Community Foundation, and establish a dialogue for things that may be helpful as you are communicating to your clients. So please, approach this as an open dialogue, pause with questions, and I'll do my best to address anything that may be on your mind. And really the key themes that are on our minds, and probably your minds and the minds of your clients, are themes around inflation and interest rate pressures. That seems to be dominating discussions across the Wall Street Journal, Bloomberg, CNBC. These are probably the most important themes in terms of impacting overall capital markets going into 2022 and beyond. And of course, we're now seeing inflationary pressures that we haven't seen in 40 years. And I think we all recognize that this is something that has been in store for a while. The Federal Reserve tried to make a point earlier this year, last year, about these themes being transitory, and that argument really fell flat. It's hard to think with that level of stimulus that is now 2 or 3 times greater than what we saw during the global financial crisis, the amount of Treasury debt outstanding, the amount of money supply just being injected in capital markets and economies worldwide, that we wouldn't be having this discussion. And there's some other prevailing themes that were in place that helped exacerbate that inflationary trend. But obviously, when prices start to increase, the Federal Reserve, which is primarily charged with observing unemployment or employment levels and inflationary pressures, will take action. We saw interest rates increase to about 2.5% following the global financial crisis, starting in 2015, with incremental increases of about 25 basis points per hike. The message at the end of 2018 was that we would see additional rate hikes in 2019. That, of course, didn't happen. Equity markets sold off. Bonds were flat. The Federal Reserve walked back interest rates by about 75 basis points in 2019. And of course, that came all the way back down to zero right when COVID started as a way to stimulate financial markets. And that has certainly happened. Low interest rates leads to very low cost of borrowing, very low weighted average cost of capital, and very, very lofty equity market valuations. U.S. equities and equity markets worldwide have achieved levels that we haven't seen. And we're starting to see a little bit of a pullback now as interest rates have increased and valuations, especially around growth stocks, have started to walk back. So the key messages here are inflation and interest rates. And then we hear a lot of talk about supply chain challenges. And these are undoubtedly challenges that are suppressing the ability to bring supply to meet demand levels. But these are also instances and shortages that have been exacerbated by COVID. When we think about ports, the efficiencies of ports in the U.S. for bringing goods to consumers, the 2 largest ports probably in the U.S., but definitely on the West Coast, are the ports in L.A. and the port in Long Beach. And there are mechanisms and metrics that evaluate the efficiencies and costs of these ports. The U.S. does not have one port on its shores that falls within the top 50 of most productive, most efficient, or lowest cost ports. The ports in Long Beach, the ports in LA rank around 328 and 333rd as overall efficiency. The only port in the U.S. that has some sort of semi-automation is in the Hampton Roads area in Virginia. It is the 85th most efficient port and 85th most cost-effective port. They do not have backloads. They are handling record volumes. but they're still not able to keep pace. And part of that is attributable to punitive labor contracts, longshoreman contracts, union contracts that impact the amount of days or hours operational, whether or not you're operating on weekends, and the overall cost. So there's some port implications that have impacted overall labor shortages, not just supply chain challenges. When we think about manufacturing in China, labor shortage that exists within Chinese markets and Asian markets just in general, those are some of the most COVID restrictive markets. So to the extent we have labor pressures here, we have probably more labor pressures that exist in Chinese markets. So factories are sitting idle. Fewer people are working in those markets. Fewer people are manufacturing goods that are being consumed by American households. Obviously, limited opportunities in fixed income, and that's a discussion point that it's been top of mind for a number of years. We've seen allocations to fixed income come down as yields have just become less and less compelling. Obviously, the pressures from rising interest rates also put downward pressure on bond prices. One of the things we'll see here in just a minute is that we've experienced now the fourth negative calendar year return since the inception of the Marquette Aggregate Bond Index, since the index's founding in the late 70s. So negative bond returns in an environment with very low yields and rising interest rates have caused many investors to walk back the amount that they allocate to fixed income. As a large institutional investor, we have access to other asset classes that can help make up for some of that difference. But for some individual clients where the options are limited to sort of stocks and bonds or traditional asset classes, there's a limited appetite or a limited ability to allocate to things like infrastructure, private credit, private equity. So bonds have unfortunately offered, apart from sort of protection in down markets, very little return unless we're allocating to high yield or senior secured loans, something with variable rate debt. And then obviously volatility is always going to be part of an investment program. Stocks are becoming more and more volatile, especially as we see a proliferation of ETFs and index funds. And there's things we do within this community foundation that helps mitigate some of that volatility. But volatility is just a necessary evil when it comes to equity market investing. So in terms of key themes around inflation, and these charts here show or illustrate that inflation has been a challenge not just in the U.S. but basically every major market, especially emerging markets, China, Russia, Brazil. We've seen, or we'll see in just a minute, we're starting to see interest rates increase in those markets to suppress these levels of inflation. And at the very bottom line, Japan, which was actually in a deflationary environment for the better part of the last, or at least a low inflation environment for the better part of the last decade, due to demographic shifts, a very sort of stagnant immigrant community, very few women in the workforce. We've seen just a contraction in prices, except for now where we have seen some inflationary pressures. So this is a phenomenon that exists or persists not just in the US, but in basically every single market, whether it's emerging or developed. Of course, it's going to get worse before it gets better. I don't think that that's probably much of a surprise. Inflationary pressures are expected to progress into 2022. December CPI, or the Consumer Price Index, touched 7%, which is the highest reading in 40 years. The expectation is that there will be a return to normal with respect to overall supply chain logistics, but labor shortages will probably take much longer or much more time to turn around. There's some significant changes in the way that Americans are accessing the workforce that will lead to increased pricing pressures. We think about childcare and the challenges that are associated with a work from home environment. We see more and more working mothers exit the workforce. We've seen an acceleration of retirement. We've seen challenges with immigration that existed in advance of the Biden administration. Fewer and fewer visas were issued for temporary workers, for migrant workers, and all of that limited the amount of labor that was brought into these markets. The gap between filled and unfilled labor. Let's see. What's this one here? The gap between filled and unfilled, you can't see the blue line. So the line at the very top is the amount of job openings That's 10, or call it 10 million. Yep, 10 million job openings and only 10, call it 6 million applications. So the point here is that there is a gap of around 4 million in terms of the jobs that are open and the jobs or the employers that are looking to fill those jobs. And anytime you have that sort of gap, to bring people back into the workforce will require either more favorable labor terms, higher wages, higher capital contributions to 401k plans. And obviously there's an amount of stimulus that's causing employees to stay idle on the sidelines. So not until this wage difference is actually reconciled and workers are brought back into the workforce would we expect to see this gap to close. And those wage pressures are probably more permanent shifts in inflation. And that's something that's very difficult to sort of reconcile over a relatively short period of time. We see employers or employees moving from state to state, selecting to be self-employed rather than working for an employer. And that further exacerbates the gap between the skills that are required and the skills that employees have. And then unemployment, which the gray line here is basically a natural level of employment, which hovers around, call it 4%. And obviously we saw a massive spike in unemployment following the COVID crisis, but that very quickly corrected itself. And we are now back at a regular level of employment, or a natural level of employment that hovers around 4%. That does help with the overall wage pressures, but it also creates more and more wage pressures across different industries and different segments. And then rent increases. What we saw in just December, 1 month alone, was a 50 basis point price in rents, and that's across all different markets, whether it's office space, retail space, industrial space, multifamily. But the price is that rents are increasing, and there is a demand for space across some, and there's in some markets, and there is a limited demand across others. But obviously higher rents lead to more pricing pressures. Travel projections, obviously travel ground to a halt, and there's still there's just sort of fewer flight options. And getting here today is much more challenging than it was 12 months ago or 20 months ago. And we're starting to see a renewed interest in travel. And this varies sort of from state to state or country to country. But to the extent that there is an increase in travel, increase in obviously in overall oil prices, all of that leads to increasing costs to conduct business. Then, of course, weddings. Millions of Americans have delayed weddings as a result of COVID. Gatherings were restricted. There is less help to assemble these weddings. But obviously, this leads to an increased cost of either the venue or the food that's being served, the beverages that are being served. But a backlog of weddings has led to, and this is just an example of where pricing pressures are coming from, but there's been a backlog of gatherings that have increased the overall pricing pressures. So what will the Fed actually do? And the Fed was clear in November that they will walk back or reduce the amount of stimulus. The bond buying program, or quantitative easing, that was introduced as a result of the COVID crisis amounted to about 90 billion in bonds purchased per month across treasuries. They announced that they would purchase corporate credit. They never actually did. Mortgage-backed securities, some asset-backed securities, to the tune of 90 billion per month. The amount of treasury debt outstanding at the end of 2021 was close to 30 trillion. I think it was closer to 28 or 29. But 28 trillion in treasury debt outstanding puts money into the economic system. As we'll see in just a minute, the Federal Reserve had basically purchased about 25% of that. But the Federal Reserve will start to unwind its bond buying program. By March, that will be completely unwound, and the amount of bonds purchased by the Federal Reserve will be closer to zero. But if the Federal Reserve is not buying bonds, and buying bonds puts downward pressure on interest rates will start to decrease. And that's what we're seeing in markets right now. The 10-year Treasury has gone from about 93 basis points at the end of last year to about 190 basis points. Upward pressure on interest rates means lower valuations, generally speaking, for equities. And we're seeing that most notably across growth and tech sector. Apart from the 5 names, or if it weren't for the 5 names in the NASDAQ, which it was a tech-heavy index, the NASDAQ would have been down around 20% in 2021. It's those 5 or so names that have really supported overall equity market valuations, higher interest rates, higher cost of capital, lower net present value. And that's what we're seeing in equity markets right now. And the U.S. is not alone in its expectation to actually raise rates. We've seen rates already increase dramatically, whether it's in Brazil or Russia or even China, where interest rates are north of 3%. And that's attributable to inflationary pressures that exist in those markets. We have lower levels of inflation in general across Canada, or U.S., Eurozone, where we haven't seen rate rise in rates, but that is coming. Now, the magnitude of those changes, those hikes, we'll look at towards the end of this. But upward pressure on short-term rates usually has downward pressure on the valuations of companies, the cost of capital, the cost of borrowing, the cost of conducting business. And rising interest rates is meant to suppress overall economic growth. Now, whether or not we'll get back to the levels that we saw the earlier part of the 2000s is pretty unlikely. There were huge demographic shifts that brought down interest rates over a period of time, and it's unlikely that we will return back to an environment of 5-6%. Maybe 3% is a little bit more likely over the course of the next few years. So in terms of in this fixed income section, so one of the things we'll spend some time with are the overall asset classes, especially the asset classes that are part of this portfolio: fixed income, public equities, and alternative asset classes. So the key driver of overall fixed income returns this year are largely driven by interest rates. And we can see, really from, I think it was March of 2020 is when short-term rates fell back to zero. They've basically been flat over the course of the last 18 months, which has been very accretive to overall stimulus and economic activity. But what is also important is the change in the 10-year Treasury from 93 basis points at the end of last year to 150 basis points at the end of 2021. And now the 10-year is somewhere in the neighborhood of 1.9%. That really has driven the overall impact to fixed income. The benchmark at the very top is the Bloomberg Barclays Aggregate Bond Index, which is investment grade corporate mortgage-backed securities in treasuries. This benchmark, unlike equity market or equity benchmarks, is constructed by amount of debt outstanding. The U.S. Treasury is the largest or one of the largest issuers of debt in the world, and U.S. Treasuries represent roughly 50% of the Bloomberg Aggregate Bond Index. Very interest rate sensitive, very little credit exposure. So as interest rates increase, bond prices come down, and this negative 1.54% is the 4th negative calendar year since the inception of this benchmark back in the late 70s. By contrast, equity markets have obviously performed incredibly well, but credit markets have performed very well, whether it's levered loans, senior secured loans with variable rate debt, or high yield, have credit or equity-like characteristics, and we see credit do reasonably well when equity markets are outperforming. And this is why we have exposures to variable rate debt and high yield within the foundation and other client portfolios. And this is probably something that your clients are asking about or have in their portfolios, especially those clients that have an appetite for higher yield. And so with respect to the overall Fed balance sheet, as I mentioned earlier, the U.S. Treasury has issued or now has about $28 trillion in debt outstanding. The Federal Reserve owns 25% of that. That is a very captive buyer. If the Federal Reserve is buying that much of debt, bond prices are going to go up, interest rates are going to go down. And when that starts to become unwound, when they are no longer buying $90 billion of bonds per month, we are going to see a rise in interest rates. And this is just a consequence of unwinding quantitative easing. We saw quantitative easing go into effect right after the global financial crisis, and that slowly started to wind down, and it was winding down much into 2019. And of course, COVID hit, and that was accelerated once again. And this is a tool that which is a relatively new tool that the Federal Reserve uses when interest rates are already at zero. It's very difficult to lower rates even further. We've seen some markets in Europe move into negative yield, and that really hasn't fared very well for those European capital markets. So quantitative easing, the act of buying bonds, is a way to stimulate or shorten interest rates on the longer end of the curve. And if anybody has questions, please stop me. We can look at squiggly lines all day. With respect to equity markets, and no surprise here that equity markets have performed incredibly well. What's interesting about this illustration or this chart is that large cap has outperformed mid cap and small cap, but that we saw a return in the performance of value stocks. These tend to be higher dividend paying companies, financials, utilities, real estate versus tech, healthcare, et cetera. And we saw a massive sell-off or underperformance in small cap growth in particular. But over the longer term, growth has still outpaced value. And that's been one of the best places to be. In fact, Russell 1000 growth has almost returned 20% over the last 10 years annualized. That's more than, or almost 3 times higher than what we would expect for normalized equity market return. Our capital market assumptions generally suggest that equities should return somewhere between 7 and 8%. Over the last 10 years, that number has been 20%, much, much higher than we would expect. And I think a natural inclination is to experience mean reversion should we start to see a deterioration in overall performance. And that could be pretty likely. The likelihood of 20% persisting over a longer term period of time is very, very low. But that doesn't necessarily suggest that we should see equity markets sell off over the next few years. Yet maybe we could see low or mid single digits. But this doesn't necessarily suggest that we should see an equity market sell off unless there is a dramatic spike in interest rates or some other unforeseen circumstances that are always difficult to predict. Non-US markets have fared reasonably well, especially developed markets. The MSCI EAFE, which is a developed market index, up somewhere in the neighborhood of 11%. However, emerging markets, which typically offer one of the best rooms for growth in traditional asset classes, sold off significantly this year, down 2.5%. China represents 35% of this particular index. Increased regulatory challenges, antitrust organizations have been giving within China have farther reaching power, have more policy, more instruments to effect change, and that probably has had an impact on the robustness of overall Chinese equity market growth. This is a market where we tend to see the highest levels of GDP expansion due to population shift, middle class, or rise in middle class. But obviously there has been some punitive measures, especially around technology and real estate companies in Chinese markets that put downward pressure on emerging markets overall. We tend to see expectations for emerging market equity between 7.5% and 8%, which is among the most attractive for public markets, but that certainly wasn't there last year. Now, one of the themes that we've seen, or at least been led to believe, is that once new variants have been introduced, we see equity market sell-offs. And of course, that was the case when COVID was first detected in February and March of 2020. Equity markets sold off significantly. But beyond that, there has been very little movement, or at least longer term movement, once the alpha variant was detected. I didn't even know there was a gamma and beta variant. Did anybody else know that? Yeah, no idea. In Omicron, we did see a sell-off in November and December, but that seems to have largely abated as markets have come to grips with the fact that while it may be more contagious, the implications of the Omicron variant are much less severe and probably no different than a common cold. So markets, almost like everything, shrug this off easily, and that largely, again, supported by a tremendous amount of stimulus. Free money or very cheap money have allowed equity markets to expand. And just an interesting illustration, I think it helps put equity market investing in perspective. Every single one of these bars represents the actual calendar year return for that calendar year. The green diamond represents the amount of the largest drawdown in that particular year. So on average, every other year, U.S. equity markets experience a correction, a sell-off of 10% or more, a natural part of equity market investing, the sell-off of 10%. Every 20 years or so, we experience, every 10 years, we experience a bear market, which is a sell-off of 20% or more. We saw one, of course, in 2020 that was very short-lived. We saw one in 2008 following the global financial crisis. And then we saw one in obviously the dot-com bubble, and then in the early 1990s. So these ebbs and flows are a natural part of equity market investing. We try to mitigate this volatility by allocating to fixed income, which exhibits one of the lower correlations to equity markets, and then by allocating to alternative asset classes, real estate, private equity, infrastructure. Just because those asset classes aren't marked to market every day helps mitigate some of those themes around volatility. And for a portfolio in particular that tends to be cash flow positive, the volatility isn't as impactful as maybe a more seasoned portfolio that's requiring more draws on cash. So volatility certainly creates noise, concern, confusion, perhaps with boards, committees, and individual investors. But unless there's a real draw on that capital, the implications of selling low or selling at a period of equity market sell-off isn't all that impactful. Not surprisingly, the gray bars here illustrate the sectors that have performed the best over the year-to-date period. Energy, financials, real estate, some of the asset classes that were most impacted during COVID. A lot of these are referred to as cyclicals. These are asset classes that got hit first by COVID, but really started a significant rebound in October and November of last year. Many of these sectors are also value sectors, and that's largely responsible for the rebound that we've seen in value relative to growth. Growth sectors, on the other hand, tech in particular, experienced the most significant rebound as Americans and workers worldwide started to work from home. Technology now represents almost 26% of the U.S. equity market broadly. And to the extent we see higher interest rates, that's when we see a bigger impact on technology names in particular. And then utilities, which is a relatively small portion of the overall U.S. equity market, tends to be more interest rate sensitive, capital markets or CapEx sensitive. And when bond prices increase, interest rates decrease, that tends to have a favorable effect on utilities, and vice versa. When interest rates increase, utilities tend to fall out of favor. And for the first time in quite a while, most growth from equity markets was driven by earnings. We saw a lot of top line growth, lower costs. Much of the inflationary pressures were passed back on to consumers, and evidenced by this light green bar. Most, if not all, of the return from equities came from earnings growth, which is a complete contrast to the story that we saw unfold in 2020 when there was virtually no earnings growth. And the expectation is there still should be some lingering effects of earnings growth in 2022 as consumers still are spending. We see a shift away from buying goods to buying services and a tremendous amount of cheap capital, but we obviously or probably won't see the same magnitude of earnings growth expansion that we saw in 2021. And this chart here, it's an interesting one. The implication is that as interest rates increase, we tend to see, or we would expect to see, a sell-off in overall equities. And we've divided this chart between pre and post global financial crisis, just because there's a number of different changes that have impacted the overall level of interest rates. But the main point is when we start to see changes in interest rates, there isn't necessarily a massive change in the overall performance of equity markets. Now, if we start to see interest rates that creep into 3%, 4%, 5%, much higher weighted average cost of capital, that could change things. But interest rates have been so low for so long that minor changes, whether it's 100 basis points, 250 basis points, is still a very low interest rate environment. Borrowing costs increase, the discount rate increases, and we're discounting sort of either dividend or some sort of cash flow at a higher and higher interest rate or a higher and higher weighted average cost of capital. That could bring equity valuations down. Not expected based on this chart, and probably something we won't see unless we experience a dramatic increase in overall short-term rates. China's GDP is expected to slow. I think that there's also been a fair amount of skepticism around the accuracy of some of the data that comes from these markets. It's very difficult to determine how impactful COVID has been, how many factories are actually shutting down, how many workers are actually pulling out of that workforce. But the expectation is that GDP, like most other markets, will pull back as COVID impacts linger. And China has had the most suppressive restrictions as a result of COVID the aspirational goal is, zero cases of COVID, which is probably something that's now just unattainable. But more restrictions will suppress GDP growth. So we saw a contraction in one of the largest in quite a while in 2021. Chinese equity markets have been incredibly robust, especially in 2017. We do see a lot of volatility. 2019 or 2018, when interest rates were expected to increase, they didn't, and we saw a rebound in 2019, 2020. But generally speaking, higher allocations to emerging market equities should lead to overall higher expected return, but it's going to come with a tremendous amount of volatility, as we see in Chinese equity markets. So alternative asset classes, and I think for most individual investors, these are asset classes that tend to not be part of a portfolio, but it's a very important part of this portfolio and the portfolios of other institutional investors. And normally when we think about alternative asset classes, we refer to real estate, infrastructure, private markets, private equity, private credit. Marquette has not advocated hedge funds. We don't have hedge funds in this portfolio. Hedge funds tend to be expensive, super crowded, and have generally underperformed. Now, in an environment like this, there can be some appetite or benefit of credit hedge funds, macro hedge funds, but generally we have steered clear of that asset class. Real estate surprisingly has done remarkably well. We think about the four major asset classes or sub-asset classes within real estate. That's office, industrial, multifamily, and retail. Retail has contracted over the years in advance of COVID. It's just the appetite for brick and mortar retail has disappeared. And not surprisingly, that is the lowest performing sub-asset class, down 1.4% over the last 3 years. By contrast, the industrial space, which is a result of the Amazon effect, the change in the way that Americans consume, businesses consume. We see them on the highways. They're being built all the time, closer to consumer, bigger bays, deeper concrete, and ability to withstand more and more inventory, and just-in-time inventory has been the best performing sub-asset class. And just incidentally, as we think about these supply chain challenges, labor shortages, producing goods overseas, and then bringing them to the American consumer, the challenges that are associated with that structural change over the last 2-3 decades may unwind because it's so much more difficult to control, and American consumers are looking for just-in-time inventory, ordering something today, having it at your mailbox or the very next day. So we may see changes in the way that American goods are produced overseas, and an increased appetite for overall industrial space. Office space, actually I'll come back to that in a second, apartment or multifamily. Households will always need a place to live. Multifamily tends to have the shortest lease duration of about a year. So as prices increase, as there is a shift away from maybe owning a home to renting a home, we tend to see higher and higher leases over shorter time periods. Those leases reset about every year. Office space, on the other hand, tends to have a longer lease. And while we haven't seen a material change in vacancies, that doesn't necessarily mean that office workers are going to resume the use of their office space. These leases just exist for a longer term period of time. And this is a market where we probably will see the most amount of uncertainty. Employers still don't know what their policies will be going forward, what that demand will look like, what the appetite is for living in city centers will look like. And I think that's where we see the biggest challenge. The expectation going forward is that industrial and multifamily will be the best returners on the total return and income basis. The appreciation is basically, it tends to increase at overall levels of inflation. Over the long term, we see more appetite for apartment and retail or industrial in terms of overall price appreciation. In real estate, income tends to be very, very consistent, especially in the core real estate space. Income since the inception of this particular index, which is the NCREIF Odyssey or the open-end diversified core equity index, is around 4%. So if we see inflationary returns from capital appreciation of around 3 to 4%, consistent income around 4%, the expectation for real estate is around 7 to 8%, and is what we've experienced since adding the asset class to the portfolio almost a decade ago. And here, just an expectation around vacancy and net absorption. So the amount of properties that are coming to market, the completions, an increase in completions, net absorption is how much of this space is actually being purchased or leased. The absorption has started to decrease, and that means that vacancy rates are expected to increase. Now, this is probably the most prevalent among office space. Multifamily absorption is high, vacancy rates are low. Retail represents now only 15% of this particular benchmark, and it's really contracted over the years. The need for retail has dwindled long in advance of COVID. And in infrastructure investing, infrastructure is an asset class that's been around for a while. It's still a real asset, similar to real estate that we have in the portfolio. The foundation has made an allocation to infrastructure, which generally exists across roads, rail, ports, airports, power, water, telecom. And this is an asset class that can be thought about in two different ways: GDP sensitive assets and contracted or regulated assets. GDP sensitive assets are assets like rail, ports, airports that tend to ebb and flow based on consumerism. If there's an appetite for more travel, more goods, we tend to see more travel on toll roads, we tend to see higher rents. By contrast, regulated or contracted assets like water, telecom, power, that's a service that's used regardless of overall economic conditions. And that's part of the reason it's an attractive addition to any portfolio. Low correlations to economic outcomes, economic conditions, and services that are used regardless of overall economic conditions. So we think about the income that's generated from each of these services. These are paid for service types of instruments. And to the extent there is a constant need for water, telecom, power, that is dividend or income that's placed into an institutional portfolio. And these assets tend to have valuations that increase with an overall level of inflation. The benchmark that's usually used is CPI +4, CPI +5, something of that nature that allows for an adjustment to inflation. They tend to have very low levels of volatility. These are long-lived assets that are very well aligned with the long-term time horizons of a pension plan or an endowment or foundation. Again, reliable source of income, similar to what we saw with real estate. The income component associated with infrastructure or any sort of real asset is very consistent, dating back here to 2009. For real estate, it dates back even further. But it's that consistency that comes with real assets that make this a very suitable complement or replacement for the low levels of income that are associated with fixed income. In private equity is an asset class that we have introduced to this portfolio and many other institutional portfolios, especially in the E&F space over the years, because of the attractiveness of return. We are trying to do three things when we build portfolios, whether it's for an individual or an institutional investor: grow assets to meet long-term spending or long-term obligations, generate yield for current income needs, and diversify risk. This is an asset class that offers the most room for long-term growth. And part of the reason that that's the case is just the opportunity set. We think about companies or equity investing in the public space in the US. It's a relatively or very small sample size of the amount of corporate ownership that we have access to as institutional investors. In the US, there are 20,000 companies with annual revenue in excess of $100 million. Only 13% of those companies are publicly traded, or roughly 2,600. By contrast, there are 17,500 companies with revenue in excess of 100 million that are available to investors that are willing to access private markets. As we look at companies with greater than 5 million in annual revenue, that number is much, much higher. There are literally millions of companies in the United States with revenues in excess of $5 million. And for investors that have the liquidity, that have the patience, they can access these markets. And that's part of why, and this is part of the reason we've seen such healthy growth in this portfolio, is accessing the inefficiencies that come with private market investing. The other sort of picture or illustration behind this is the number of public companies has contracted over the years. 20 years ago, the Wilshire 5000 had over 7,000 publicly traded companies. That number is now 3,500, 4,000 companies. The number of publicly traded companies in the US has just deteriorated as regulatory burdens have increased, as regional banks have been gobbled up by larger banks. Just the opportunity set is dwindled. More and more capital chasing public companies creates more and more efficiencies. Active managers struggle to outperform. That's why we've seen a proliferation of index funds, a proliferation of passively managed ETFs is a way to access public markets with very, very low costs, and then using active management budgets more responsibly to access the real alpha that comes from small cap premium and public or privately held companies. And then, not surprisingly, there's been a record number of private equity deployment. Part of the increase of 2020 to 2021 is just due to idle dollars not being committed to private equity. And we've seen a huge rebound as managers have come back to market, raised bigger and bigger funds, and put that money to work more quickly. But deployment has exceeded 1.2 trillion, which is an absolutely staggering amount, and probably leads many investors to wonder if there is a frothiness that exists in private markets. And I would argue that there is, but as long as you're not chasing the larger deals, the larger valuations that are probably more applicable to large state investment plans, sovereign wealth, participating in lower middle market, small cap space, there's still very attractive valuations. So this is a very important area for investors to access durable businesses, family-owned businesses that need a healthy amount of professionalism to grow a business in a sustainable way. And we also see, as part of this sort of venture capital investing or software, telecom, media, a very attractive place for investors who are looking for growth opportunities. And we have a blend of both within this portfolio. That was a lot all at once. I'll be happy to take any questions or talk about anything that's on your mind, your clients' minds. It's a lot to think about, but I don't think any of us will be surprised if we see, actually, a few more things that are worth pointing out. In terms of overall projections, and this is based on the Federal Reserve's economic projections, not just Marquette, GDP will start to slow over the long run as we see more and more pricing pressures, as we start to see higher interest rates. The unemployment projection, again, will come back down. We already, as I mentioned earlier, we're back near natural levels of unemployment, which should hover around 3.5% to 4%. And that should create some balance between the amount of openings that employers have and the amount of jobs that employees are trying to fill. And then inflationary pressures, personal consumption index at the very end, inflation should start to subside by 2024. Is one thing we probably won't be able to unwind or rising wage pressures, but challenges around supply chain logistics should become more manageable as COVID issues subside. In terms of overall short-term rates, the expectation, and this is based on the spot market, this is what the market thinks will happen to short-term rates. This is not projection from any sort of organization, just where do we think rates will be over the short term. There's a flattening of the curve, meaning that we won't see, or the market's not expecting us to see massive increases in the 10-year rate and beyond. But the short-term rate should move from basically 0% to almost 1.75% over the course of the next 3 years. That's not a massive increase. I don't think that we need to be concerned of interest rate levels not seen since the early 80s, 20% short-term rates. That's not very likely based on market expectations. And then what asset classes will perform well when rates rise? And historically, equities have performed incredibly well. Real estate has performed well. Bonds tend to perform poorly during periods of rising interest rates. Higher rates, capital market depreciation based on the overall level of duration. The one point to note here is that usually when we see economies overheat, companies do well, share prices do well, much of those inflationary pressures are passed back to consumers. It's only when we see a large increase in interest rates do the brakes tend to be put on overall equity. So, we think about these characteristics, this market outlook, not as a way to make structural changes in strategic asset allocation, but to be thoughtful in the way that we shape client portfolios, rebalance client portfolios, and most importantly, communicate messaging. Part of our job, part of your job when you're speaking to your clients is to minimize surprises. We don't want anybody to be caught flat-footed, and we have certain expectations around asset classes or capital market assumptions that allows us to be prepared. There can always be a large pullback. We saw one in 2 years ago, but through a diversified portfolio of public and private markets, we wouldn't expect that pullback to be that severe. And of course, rebalancing during inflection points is a key way to capitalize on price pressures, whether that's through natural inflows or just ongoing rebalancing. Buying low and selling high is what we're all trying to achieve. And just being thoughtful and disciplined when it comes to overall investment policy is a good way to capture that dislocation. What's on your mind? Yes, sir.
Well, Dave, given the tremendous performance that you and Marquette and the investment committee of the last couple of years have produced, what I'm hearing you say is like we should prepare that may not be what the chair of the committee and the group going forward maybe should expect. Is that right?
Yeah, it's never going to get any, but this is it. This is killing it. We're at the top of killing the dark.
Timing is everything, right?
One more year of this is all we need.
The chair always wants the easy way out, right?
All joking aside, maybe you could talk a little bit about what we have done. You talked a little bit about private equity and some of the conversations we've had, but back to your point about, I think most of us know we're not going to just go to cash if we have another inflection point. We're not going to abandon the strategy. The way the budget works here and the cash flows, you touched on that, but could you go a little deeper and also maybe touch on kind of what we've been doing and what our longer range thoughts are with some of the other things that we're starting to introduce or have introduced?
Sure. Yeah, happy to do that. And when we think about, and this portfolio has really been, or the strategic asset allocation has been intact for almost a decade. We obviously revisit asset allocation regular intervals, usually every 1 to 3 years, to make educated decisions based on what we're seeing in the market, based on expectations for cash flow. And the objective here is aligning the return objective with risk tolerance, both the ability and willingness to bear risk, and time constraints, liquidity needs. And this organization has benefited from positive cash flows, meaning that you can take on more illiquidity risk. And we've done that in a thoughtful way. We didn't just jump into private equity and increase the allocation. We ramped that up over a period of almost a decade. We started with a 10% goal allocation. We looked at that last year. We increased the goal allocation from 10 to 15%, and we ramped that up slowly over time. And a liquid asset class like private equity doesn't allow us to simply rebalance or load that asset class up. We have to position that over a period of time as managers call capital. And one of the biggest risks that we can make is a private equity investor is vintage year concentration, having too much invested in 1 year, and manager concentration risk. So we need to be thoughtful in the way that we deploy that capital. And we think about, again, the 3 themes that we're trying to accomplish is any sort of investor, whether you're individual or an institution, grow assets, generate income, diversify risk. And that's exactly what we've done with this portfolio. We started with a 20% allocation to fixed income, allocated across investment grade credit, treasuries as a core bond portfolio, senior secured loans and high yield to mitigate any sort of impact of low interest rates or rising interest rates. And then global fixed income. Obviously, the yields in global fixed income are low, but it allows us to have an expanded opportunity set. We will bring that allocation down as infrastructure becomes funded. And that really is probably the most meaningful change that we've made to the portfolio in the last few years, is a new commitment to infrastructure that's not yet funded, but will be soon. Within our U.S. equity and non-U.S. equity portfolio, we're very thoughtful in the way that we approach active management and passive management. Active managers have struggled to outperform due to a proliferation of private markets, deterioration in the number of public markets. And just active managers over the long term have a hard time outperforming net of fees. So we have passively managed strategies in U.S. large cap core, U.S. large cap value. We have a growth manager, Baird, out of Milwaukee, DFA, which is called a quant active small cap manager. And those two active managers have performed very well over the short term. And we have the same philosophy within our non-US equity strategies: develop market indexing, dedicated EM active, dedicated non-US small cap active, and managers that generally have outperformed over the long term. And then accessing private markets in a way that truly add value. And we started with a diversified private equity fund of funds, portfolio advisors. We invested in 2 of their funds. We now have, I think, 25 million committed to private equity. We've ramped that up over a diversified strategy over the last few years. We've made dedicated allocations to small buyout. And then earlier, or at the end of last year, we made a dedicated allocation to venture capital fund of funds. Truly, growth equity is a way to enter into the private market space, have a diversified exposure, and then capture durable small businesses. When we think about small cap investing in public markets, there's inefficiencies that exist. There's inefficiencies that exist in private small buyout as well. These are durable, family-owned businesses that have been around for years, for generations, but just need an element of professionalism, better management, better liquidity terms, better access to suppliers, better access to customers. And that's what private equity sponsors bring, is that level of professionalism to help truly grow a small company and then sell it either to a corporate sponsor or to a larger private equity fund, or probably even take public. That's something we see less and less of over the years. But the idea is still the same in private equity. It's to nurture and grow a business and exit at an attractive valuation. And that's part of the reason that we've seen the most, these very high returns from private equity and why we have it in the portfolio. But we've been very thoughtful in the decisions that we've made over the years. We haven't overhauled the portfolio. We haven't had to. We've made thoughtful decisions along the way in terms of the vendors that we partner with, the other managers that we have in the portfolio, and we've kept costs low. And all of those things over the long term tend to lead to very healthy wealth accumulation. And we look at the portfolio in December of 2012 versus December of 2021, we were rewarded for our efforts. As Kay mentioned earlier, we've gone from about 50 to almost 160 over that time period. Good decisions, low cost. Good leadership.
Good counsel, good collaboration.
Yeah, all the above.
Thank you.
What about political implications? Do you even consider? Because I don't think I saw a slide on that.
Yeah, so generally speaking, markets shrug off geopolitical considerations. I mean, there has been some war that the U.S. has been involved in the last 20 years, and those geopolitical tensions might cause a blip. Now, a more prolonged confrontation between the U.S. and China might make a bigger difference. I think there's ramifications around administrative goals and policies. The Trump administration didn't allow for, definitely had a suppressed immigration policy that created or exacerbated some of the labor shortages. Those policies are changing a little bit under the Biden administration. But generally speaking, equity markets don't react all that violently to just sort of change in political tone.
Even the deficit.
Yeah, I mean, the deficit, I think the deficit and the amount of debt outstanding sort of go hand in hand. And that's, created a huge amount of stimulus. And part of the reason that we've seen and the walk back of the bond buying program is going to have an impact on overall interest rates that may suppress equity market growth over the short term.
Cool. Well, thank you very much, Dave. We so appreciate the leadership that Marquette Associates and Dave in particular have provided our organization. And certainly we just love the model of having the opportunity to work with local investment experts that can help really guide and direct the next steps for our foundation as we carry out our fiscal responsibility as an organization. So we're certainly appreciative of Dave's expertise. There will be a quiz now for everyone, right, Dave?
Yes.
I say that every year, and I'm the one who takes the less notes, but lots of great info. And we are going to be sending out these slides to folks. Is that right?
Yeah, it's up to you. You have them in your inbox. Feel free to send them
Yeah.
out.
Yeah, so we can send those out to everybody because I know it's a lot of information and data to go through. So I think with that, we'll go ahead and conclude this portion of our professional advisory meeting. And we, again, thank everyone for coming. And we're going to move into our investment committee meeting in the next couple minutes. So thanks, everybody.